Welcome back, fellow dividend and value investors. In today's video, we will be talking about the power of slow compounding. I think we are already quite familiar by now with the power of compound interest. This is especially powerful when you are aiming for a get-rich-slow strategy, like for instance dividend growth investing. Most of your wealth is generated later on in the journey, as you can see really nicely explained in this picture. And did you know, for instance, that Warren Buffett's net worth at age 52 was only 0.3% of his current value net worth? Hence, if you're still doubting to start investing and you aim to become 90 or 100 years old, then it's definitely not too late yet. But hey, it's one way to look at it from a portfolio perspective, and that's typically what we do as dividend growth investors. But another way is to look at it from individual companies we own and want to own. Slow compounders are probably one of the best companies to own for long-term wealth. But before I get further into it, let's first look at a small explanation by Chamath Palihapitiya. Yes, I know, he's maybe not everyone's favorite superstar investor, but sometimes he does say a lot of smart things.
I think if you ask me who's building the most important indelible company in the world, I've been very public about this, I think it's Jeff Bezos. Part of what he realized was the value of slow compounding. So here's my little theory about company value creation. The faster you build it, that is the half-life. It will get destroyed in the same amount of time. And so when you think about a lot of like social businesses, that's played out. And when you see sort of like what the top, so like, does it take 8, 9, 10 years to build a really great consumer business? It'll take 8, 9, 10, 12 years to destroy it. And we may see the tipping point on a couple of these businesses. Right now, we may be seeing it in front of our eyes, regulatory or otherwise. So why is that an important statement? Amassing capital, to me, is about finding a smart, useful solution to a very hard, practical problem and being slow and methodical. And again, this is what I'm saying. You have to rewire your brain for that to be okay. And so I'm like, wow, I would really love to just compound at 15% a year. And the reason is because if I can do that for 50 years, that's $250 fucking billion, like some crazy number. Like, it's just enormous. So it's like slow and steady against hard problems.
So yeah, Chamath sounded really smart there, right? But, it means no Zoom for me or Virgin Galactic for me. And that's an irony, right? Because Virgin Galactic is actually his own spec that he introduced during the hype of 2020, I believe. Anyway, of course, these companies could be doing well earnings-wise, but I think the price reflects here also a little bit of the quality of the company here. But guys, why I like slow compounders is really because they are so easy to track and we can easily follow these companies in the news. We don't need to read every quarterly earnings report. We can do it maybe once a year, keep a little bit up to date. I mean, ask yourself, do you really need to read every quarter Berkshire Hathaway's quarterly report? No, of course not. It's of course fun to see everything Buffett has to say about it, but you don't need it because these companies are slow compounding. It's also really hard for the competition to enter the market or easily steal market share. High switching costs is what we typically talk about when we say a company has a moat. I haven't seen a lot of slow compounders without a moat. Honestly, I can't even tell you them. And also, it's so easy to spot a business in decline because it goes slow. So if this business has been building up over 50 years, then it will need at least 10 years to really decline hardly. And we can see this even with Intel today, right? It's really easier to spot a business in decline. And last but not least, it also requires long-term thinking. I believe CEOs as well, if you think about some of those CEOs of slow compounders, they don't talk about next year's earnings or like that continuously. They're talking about what they will be doing in 2025 or 2030. That's where their goals are because they fully understand what they are building. They are in it for the long run. This also means that you really need to rewire your brain because there will be less volatility. And if there's volatility, then it doesn't really matter because we're talking here about slow compounders. And a good example that Chamath just gave is Amazon. Look, this company has been building up since its foundation in 1994. Look what they have all been doing, and specifically with the product launches. They got the bookstore up online, right? But then Amazon Prime introduction, Amazon Fresh, Amazon Music, Amazon Kindle. Amazon App Store, they have built such an ecosystem. It's really, really hard to suddenly wipe out Amazon overnight. Believe me, this will take years. This will really take years because it also requires all consumers to massively shift behavior to what they are used. And Amazon has such a strong supply chain now, also with their own aircrafts and everything. It's really, really hard for this slow compounder to really get into trouble, at least in a really rapid mode. And we talk here about Amazon that has seen, of course, a lot of growth. But you shouldn't really make the mistake here to think that slow compounders don't grow fast. They can still grow fast, but it's the consistency, the year-over-year improvements, the predictability in this. Amazon is a good example of that. But another good example is IBM. I mean, a company that I often criticize, but look at that. Since 2013, it have been declining their earnings, right? I mean, how many warning signs did you need? At least until 2019, 6 years long, you could have made up your mind to keep this company or not. Nowadays, it's returning a little bit again. It's starting to recover a little bit. Maybe it has seen the bottom, but think about it. All the switching costs for customers, these big banks, you don't easily let the IBM mainframes go away, right, in your business. It really takes some time. You really do this with due diligence. That's why a company of IBM, as a slow compounder, was easily to recognize that it was going down. You just need to track it once a year or something like that. So when you think about it, if you combine slow compounding companies and this concept with Porter's 5 forces analysis, something typically people learn at business school. Now, if you're not familiar with Porter's 5 forces model, let's listen to a small introduction by him.
The basic idea of the competitive forces starts with the notion that competition is often looked at too narrowly by managers. And the 5 forces say that, yes, you're competing with your direct competitors, but you're also in a fight for profits with a broader extended set of competitors, customers who have bargaining power, suppliers who can have bargaining power, new entrants who might come in and kind of grab a piece of the action, and substitute products or services that essentially place a constraint or a cap on your profitability and growth. So the 5 forces is kind of a holistic way of looking at any industry and understanding the structural underlying drivers of profitability and competition.
So I use these to think about my rival makes it difficult for me. The threat of substitutes means I can't overcharge. The threat of new entrants means I can't overcharge.
Right.
And the same thing with the
buyers and suppliers. There's underlying drivers of each of those forces that the model really sort of unveils, and then you can actually apply this. Every industry is different. Every industry will have a different set of economic fundamentals, but the 5 forces help you home in on, first of all, what's really causing profitability in your industry.
So if we take these 5 forces of Porter really in combination with what Jamaat just said about slow compounding, I think we have really, really great businesses that with kind of predictable earnings in the upcoming years, and this is really what I love. And one more example then, what is not a slow compounder is, for instance, Facebook. Look, they benefited from the network effect. They had a new feature, let's say. They brought a product on the market, grew really quickly. But look at TikTok, how quick it's doing. It's just really threatening Facebook and Instagram and everything in this ecosystem. It's because there are no switching costs. I mean, it's just an app on our phone. We can switch immediately if there's a better feature out there that allows us to socially interact. This is really why Facebook is not a slow compounder. Yes, I have it in my portfolio from a value point of view, but it doesn't mean that I intend, for instance, to keep Facebook for the next decade. No way. So having said that, now that we are familiar with the concept of slow compounding, let me give you 3 examples. So the first one that I really would like to talk about is Realty Income. One of the most popular dividend growth stocks that we know, of course. Look at this, a compounded annual growth rate since 1994 of 15%. Really, really predictable, right? A compounded annual dividend growth rate of 4.4%. I mean, this is something that I definitely sign up for. If you do that in conjunction with a good yield, which is approximately 4% now, you have already kind of an 8.5% return for a slow compounder, really predictable company. Come on, not a lot wrong with this, right? And look at it, look at their business model. And what I really liked here is, for instance, if they look at property types but lease terms more than 10 years, I mean, they are locking in a lot of growth already because this is a triple net real estate company. So there's also a lot of benefit for the customer that is using this kind of deal, because they can really see it as a capital lease and use their money and investments for other things to invest back into the business. But also here they focus on really stable businesses. For instance, retail clients, non-discretionary. So companies that we will know do well during recessions. And look at that, 10.5% of their portfolios in grocery stores, another 9% in convenience stores, 7.4% dollar stores, so drugstores. I mean, these are really simple businesses, really predictable. If we then also look at the diversification, you see that Walgreens is only 4% as their top customer. So also from this point of view, it looks really good. And then look at this portfolio occupancy. Since 1992, it's around, now let's say always above 95% and currently at 98.9%. You can't even see a proper blip from the pandemic in 2020. This is a slow compounder, one of the best slow compounders that we can envision in the world. And look at that. This is what we love, of course, as dividend growth investors. 27 years of consecutive years of rising dividends. This is what we love, right? So if we then look at my one pager here, of course, it is a bit overvalued now. It's $69. My fair value is $45, but honestly, if it would be yielding 5%, consider me a buying. I'm not going to wait anymore for it to drop to this level. It's taking me too long, and I'm going to treat it rather like a bond because this slow compounder is there to stay. Now, before we go to the second one, I quickly also wanted to thank my supporters. Thank you, Van der Lind and Michael. Really appreciate the coffees you've been buying me. It helped me create this video, but even more, it helps me to reach my goal because I'm currently 27% on the road to meet my buddy, Engineer My Freedom, with whom I have the Dividend Talk podcast. We've never seen each other face to face yet. So I promise you, once I reach the €500, I buy a ticket to Ireland and I'm going to make it. And we're going to record face to face the first Dividend Talk over there in Watford. Thanks Van Lind, Michael. If you want to support me as well, I'll put the link to buy me a coffee in the description of this video. Really guys, really appreciate it. So the second company is ASML. You might think like ASML, high-tech company? Yes, definitely high-tech company. I mean, they own the industry. They are effectively a monopoly. And look at that. If you look at where they are, they produce these machines to build chips and create chips, right? They sell them to TSMC, one of the biggest in the world, but also to Intel. So look, this is a company that took quite a while to build up where it is now, right? As a spin-off from Philips. But let's look at it today. Look, one of their top products is EUV. There are only few machines built per year of this one. It's such a high tech that it takes so much time for other companies to really become a threat to this ASML. I mean, there's just no competition in EUV, and it will probably take 5 to 10 years for another company to come close. I know they're doing something in China there, but I don't see that as a threat at all yet. And honestly, with the geopolitical situation nowadays, does Intel, for instance, or TSMC really want to buy such a machine from China? I don't think so. So if we then look at some of the facts still here, an EUV machine is made of more than 100,000 parts. I mean, just think about this supply chain. This is not peanut butter, guys, which is consisting of nuts and some palm oil. Approximately 200 million per device, and it's shipped in 40 freight containers. Insane when you think about a single product here. And it's so expensive that just most companies cannot afford it. I mean, talk about having a moat here. And really, if you plot this in the 5 forces, I mean, it will go through the roof. But you know, they have the next product already in the pipeline, the EUV 0.55, I believe it's nanometer or something like that. It's expected to come available in 2025. And guess who's the first customer? Intel. Intel already paid up for this. They already paid billions of dollars to ASML as part of a prepayment to reserve the rights to get one of the first machines here. It should bring Intel back into competition with TSMC. So ASML, for me, another example of a slow compounder. And they have been growing slowly. Yes, with nice numbers, for instance, 20% annualized return or something like that. But no volatility in earnings, right? That's what we love about slow compounding. Hey, if I run it here through my own fair value assessment, I believe it's currently undervalued, but you do need to know that my baseline is quite aggressive because over the next 5 years, I expect it to grow with 20% annualized in their free cash flow, right? Last year they did 9.9 billion, but it had this one-off payment from Intel in there. And afterwards I expected 12% at a 10% discount rate. And I believe such a company deserves, after 10 years, still a terminal multiple of 18. I believe it's worth around 660 euros. So let's take it with a margin of safety. Let's take 120 euro off it, and you would here have it now trading, for instance, at fair value, if you consider that the fair value. So ASML, for me, it's a company. I bought already something. It's really low yield, so I don't need to own too much of it. But as a tier 4 stock, it fits in my portfolio here. Also, a 14 years dividend growth rate and a 15% dividend tax. Now, before we go to the third one, the first stock, also, guys, we have a Dividend Talk Facebook group. I closed down my European dividend growth investor own Facebook group because not a lot was going on there. There's a way more active community on the Dividend Talk group. We have currently around 620 members. Feel free to join here. There are several members there. One to call out is Alex, always active. Expect some good news about European stocks from him as well. Feel free to join because that's where we can really talk more offline. We don't need to only talk here in the comments. That's where you can find me as well after work, as an example. Guys, the third and the last slow compounder for me that I want to share is Microsoft. Again, a company that has been like on fire over the last decade, right? But look at this company, what has been doing. Windows 2, Windows 3, Microsoft Office, Xbox 380. Yes, so it started to increase its product portfolio. Microsoft Azure 2010. Look where it is now after the Xbox and Windows 11. Insane, but it's all been slow compounding. If you would draw a line like this, it would probably go something like this. They had a difficult decade between 2000 and 2010, but the business, specifically under Satya Nadella, has been growing nicely again. For me, another example of a slow compounder, but also shows you that it's not always a straight line up, but they are predictable. And it's so hard to copy or get Microsoft out of business. Look at this. Intelligent Cloud with Azure, GitHub, Visual Studio, so much used by developers. GitHub is also a standard. But think about personal computing, Xbox, Minecraft. If I see how much time my son spends on it and how many famous YouTubers there are benefiting from the Minecraft brand. Amazing. Last but not least, even LinkedIn. Who isn't on LinkedIn as a professional, right? So they can take out, let's say, GitHub or Visual Studio. The company will continue to compound because all the rest will continue to grow. So Microsoft is definitely also a slow compounder. And just look at the revenue by major product line. Of course, Azure is the highest, but also all the others are in here. This is a well-diversified company, guys. And I know the resolution is not so good of this picture, but in 2021, % expecting change in vendor spend. So this was asked to CIOs as an example, and they expected Microsoft Azure, SaaS software, and licensed software to significantly increase or to slightly increase, even more than AWS, right? So this is Microsoft. It's all over the place, and I expect it to continue compounding over the next 10 years. Really nothing in my mind that even doubts about this. And it does it also via acquisitions, right? For instance, Activision Blizzard, we're waiting here. There might be an arbitrage even possible for you if you're interested in that. And these all sound like small companies, but what they are doing is they're really step by step increasing the ecosystem of their product portfolios, and users and customers just love it. Now, it is also, a great dividend growth stock because look at how they've been doing. Currently, they pay almost $2.50 in dividends. I expect them to come in 2 weeks from now again with an approximate 10% dividend hike. My yield on cost will with that go over the 6% because I bought them, I believe, somewhere in 2016. One time at around $40, the other time around $80. I love this company. Is it now at fair value? I believe yes, it is. But also here, like ASML, I'm quite aggressive here. And hey, who says actually that dividend growth investors don't like growth stocks? So this is, in my opinion, still slow compounder. And over the next 5 years, I still expect it to grow with 20% annualized. In their free cash flow, there's only one thing that can do something against it, and that's a really deep recession. But believe me, CIOs are one of the last to cut on the, on the Microsoft bill. They will rather cut on employees and workforce to take the fat from the bone than they do on the Azure, as an example. So having said that, if you take then another 12% growth thereafter at a larger discount rate, because I have a bit more uncertainty of 12.5% and a terminal multiple of 18, I believe it's worth $290. It's currently trading at $270, but in this case, I would also recommend a 20% discount to this stock. So 20% would make it $230. So somewhere between $230 and $240. I think it's worth to add some more Microsoft. This is of course not advice. You need to do your own homework. I own already enough. I might buy 1 or 2 shares on the dip when it hits to $230. But yeah, guys, this is it from my side. These were 3 slow compounders. I hope you liked also this video. I hope you learned something with it, the concept of slow compounding. This is typically what I look for if I'm talking about my tier 1 and tier 2 stocks, because I don't want to wake up one day and suddenly the company is gone. This doesn't really happen with slow compounders, guys. Hey, if you like this, don't forget to subscribe to this channel if you haven't done so yet. Like this video, and guys, see you next time.